So, our mission here is pretty simple. Boil down key ideas for these choppy waters and give you a different way to think about crashing stock prices.
And maybe the biggest takeaway right up front, these crashes, they aren't disasters, they're potential gold mines. Let's flip the script on how we usually react. Instead of just seeing doom and gloom when the market tanks, we're looking at it, well, differently, through a lens of opportunity.
If the stock price suddenly drops, it's like your favorite thing is suddenly on clearance. Makes it more attractive, not less.
And that's the mental shift. It's huge. You have to fight that gut reaction to just sell everything because everyone else is panicking, and instead, you pause and think, okay, is this actually a chance to buy more of something great but cheaper?
And this connects directly to another huge piece of investing philosophy, which is temperament. Temperament over intellect, especially when things get crazy.
Yeah, let's unpack that because it sounds simple, but it's incredibly hard in practice.
Totally. Intellectually, we all get buy low, sell high. But actually doing it when the news is screaming market collapse and your gut is telling you to run, that's different. That's the whole point. Staying rational, keeping your emotions sidelined, resisting that urge to just hit the sell button out of fear.
Because those emotional decisions, they're usually the ones that really cost you, right?
Exactly. Selling in a panic near the bottom just locks in those losses. It's the complete opposite of playing the long game, right? We're not sitting here trying to guess the market's next move day by day, trying to time the peaks and troughs.
Yeah, a fool's errand.
We focus on owning good businesses, and potentially owning them for years, decades even, and letting that power of compounding do its thing over that long stretch.
So from that perspective, a big market crash isn't the end of the world. It's more like a blip, a temporary detour on a much longer road trip.
Exactly. A setback, sure, but temporary within that long-term view. You focus on the destination, not every pothole.
Okay. Another thing that comes up constantly is being prepared.
Yes, intellectually with calm temperament and having capital ready. Being very deliberate. It lets us capitalize on market irrationality. When fear drives prices down below intrinsic value, we want to have the cash ready to step in and buy good assets on sale.
And maybe look at this downturn as a potential chance to buy if you've got that long view and the courage to go against the grain.
Precisely. Resist the herd mentality. Think like an owner of the business, not just a holder of a stock certificate.
Okay? So let's crystallize this. Let's talk specifics about why someone might actually feel, dare I say, bullish during a bear market.
Yeah, let's do it. Okay. First, and we've touched on this a lot, the opportunity to buy quality companies at discounted prices. Simple as that. Market panic pushes down prices sometimes way below intrinsic value, even for the best businesses.
It's that sale analogy again. Great companies temporarily marked down. Makes sense.
Second is the boosted power of compounding for the long run. If you buy shares of a solid business at a lower price point, your future returns both from growth and dividends are potentially magnified.
Oh, right, because your starting base is lower, so the percentage gains over years can be significantly larger, like planting a tree in better soil.
Kind of. Yeah. A lower entry point amplifies that compounding magic over decades.
Okay. During a downturn, the focus shifts back to fundamentals. When things get rocky, a lot of the speculative froth, the day trading noise, it tends to fade away, right? People stop chasing momentum and start asking, okay, what does this company actually earn? Is it built to last? Maybe the most fundamental reason to be bullish during a market drop. Markets historically recover. It sounds simple, maybe even obvious, but it's crucial.
Every crash feels different, feels uniquely scary when you're in it.
Uh-huh. But look back at history. Markets have always eventually recovered from downturns and gone on to new highs. Always. Patience is rewarded.
So for investors holding quality assets who have that long time frame, a bear market isn't the end. It's just a phase, possibly a beneficial phase if you act rationally.
That's the essence of it. It comes back to that long-term view and, crucially, the emotional control, the temperament.
Your reaction to fear is paramount. Can you stay calm? Can you think clearly when everyone else is losing their head? So, maybe a good exercise for everyone listening is to think back. How did you react during the last big dip, or even smaller ones? Were your actions driven by a plan, by principles like these? Or was it more gut reaction, more emotion?
And maybe more importantly, what can you do now to build that discipline, to cultivate that mindset? So that next time, and there will be a next time, you're prepared, mentally prepared.
Yeah, prepared to act intelligently and rationally, maybe even opportunistically instead of just reacting emotionally when that fear inevitably kicks in.
It's about training yourself to see the potential upside when the headlines are all screaming downside.
Imagine how truly internalizing these principles, really seeing crashes as potential opportunities, focusing long-term, mastering your emotions. Imagine how that could fundamentally change your entire approach to investing and, ultimately, to building wealth over your lifetime. It's a powerful shift in perspective.
Couldn't agree more. Well, thank you for joining us. Hit the like button, share your comments, and make sure to subscribe. We're producing more videos to help you cut through the noise so you can make confident investment choices that grow your wealth.
Check out our main page and hit the subscribe button. See you next time.